Hi, good day everyone. I'm Julian D. Valderama, and this time I'm going to discuss the chapter 12 that talks about laws related to tourism, investments, and finance. So here we have our learning objectives. First, enumerate the procedure in setting up a tourism-oriented business. Second, explain the laws governing tourism investments and financing tourism-oriented projects. Third, discuss the business models applicable to tourism projects. Fourth, enumerate the various taxes application to tourism-related establishments. And last, discuss the limitation of foreigners in tourism investments. We also have the topic outlines. We have the Foreign Investments Act of 1991, investment in transportation, business and public utilities, investment in travel agencies and tour operators, investments in hotels, resorts, and other accommodation establishments, application of the retail trade law for restaurants and shops. We also have the tourism projects under the Build, Operate, and Transfer or BOT program, applicable negotiable instruments and documents of the tide, financing, credit cards, Special Economic Zone Act of 1995, business models, franchising, taxes, and barangay micro business enterprise. So, introduction. The state recognizes the importance of the private sector, particularly the tourism industry, and provides incentives for investments. This chapter covers laws promoting, monitoring, and regulating tourism investments, including special laws for certain sectors. So first law, we had the Foreign Investments Act of 1991. So a Philippine national is a citizen of the Philippines, a domestic partnership or association owned by citizens or a corporation organized under Philippine laws with at least 60% of the capital stock owned and held by Filipinos. Corporations organized abroad and registered as doing business in the Philippines must have at least 100% of the capital stock owned by Filipinos. Small and medium-sized domestic market enterprises with paid in equity capital less than $200,000 are reserved for Philippine nationals, provided they involve advanced technology or employ at least 50 direct employees. So, the praise doing business includes soliciting orders, service contracts, opening offices, appointing representatives or distributors, participating in the management, supervision, or control of any domestic business, firm, entity, or corporation in the Philippines, and any other act that implies a continuity of commercial dealings or arrangements. So the Foreign Investments Act of 1991, amended by Republic Act 8179, allows foreigners to invest in all activities and enterprises in the Philippines, except those covered in the negative list. Foreigners can determine the extent of allowable foreign equity in an enterprise by referring to the negative list and filing requirements with the Securities and Exchange Commission. So the Act requires foreigners to determine whether the enterprise is a domestic market enterprise or an export enterprise. In domestic market enterprises, foreign ownership is generally limited to 40% unless provided by the Constitution or other laws. Export enterprises can have up to 100% foreign ownership unless products or services fall within the negative list or use depleting natural resources. So we also have the investment in transportation, business, and public utilities. According to Article number 12, National Economy and Patrimony, Section 11, the Philippines public utility franchises and certificates are only granted to citizens or corporations with at least 60% Philippine capital. These rights are not exclusive or exclusive for more than 50 years and can be amended by Congress. The state encourages public equity participation in public utilities with foreign investors limited to the proportionate share in capital. So, common carriers in the Philippines operate under public service, limited to citizens or Philippine-owned corporations or associations. Participation is 40%, and executive and managing officers are exclusively for Philippine citizens. So we have the investment and travel agencies and tour operators. The following may apply for accreditation as tour operators. Tour operators must be resident Filipino citizens, have a partnership with at least 60% Filipino capital ownership, and have a corporation with at least 60% Filipino ownership and a Filipino board of directors. So next is we have the investments in hotels, resorts, and other accommodation establishments. So the 2006 Investment Priorities Plan approved Memorandum Order Number 211 classifying tourism as a preferred activity under Article 29 of the Omnibus Investment Code of 1987, covering tourism economic zones, estates, eco-agri facilities, and accommodation establishments. So to register tourist accommodation facilities under the Investment Priorities Plan, applicants must meet certain criteria. These include being a Philippine citizen having at least 60% of their capital owned and controlled by Philippine nationals, having at least 60% of their board members be citizens, proposing to engage in a preferred project within a set time frame, and being capable of contributing to the national development of the preferred area and economy. So next is we have the application of the Retail Trade Law for restaurants and shops. So the Retail Trade Liberalization Act of 2000 allows foreign investors to operate and own tourism-related establishments like restaurants and department stores, subject to capital requirements, limiting their previous ownership to Filipino citizens. So next is we have the tourism projects under the Build, Operate, and Transfer or BOT program. So the BOT law amended by Republic Act 7718 acknowledges the private sector's crucial role in national growth and development, offering incentives for mobilizing private resources for government infrastructure and development projects. So the following are the schemes recognized under the law. First, we have the Build and Transfer or BT. Build and transfer is a contractual arrangement where the project proponent finances and constructs an infrastructure, then turns it over to the relevant agency or LGU, who pays the proponent the total investment and a reasonable rate of return. Next is we have the Build, Lease, and Transfer or BLT. The build, lease, and transfer is a contractual arrangement where a project proponent finances and constructs an infrastructure facility, then transfers ownership to the agency or LGU upon completion. Next is we have the Build, Own, and Operate or BOO. Build, own, and operate is a contractual arrangement where a project proponent finances, constructs, owns, operates, and maintains an infrastructure development facility, allowing them to recover costs and a reasonable return by collecting charges from users with approval from NEDA's Investment Coordination Committee. Next is we have the Build, Operate, and Transfer or BOT. The Build, Operate, and Transfer is a contractual agreement where a project proponent constructs and maintains an infrastructure facility, charging users tools, fees, and rentals to recover investment and expenses. The facility is transferred to the agency or LGU after a fixed term of 50 years, including a supply and operate scheme where the supplier operates the facility, providing technology, transfer, and training to Filipino nationals. Next is we have the Build, Transfer, and Operate or BTO. The Build, Transfer, and Operate is a contractual arrangement where an agency or LGU contracts private entity to build an infrastructure facility, assumes cost, and transfers title after commissioning while the private entity operates. Next is we have the Contract, Add, and Operate. The Contract, Add, and Operate is a contractual arrangement where a project proponent adds to a government-rented infrastructure facility and operates it over a franchise period, potentially with a transfer arrangement. Next is we have the develop, operate, and transfer or DOT. Develop, operate, and transfer is a contractual arrangement where a project proponent gains rights to develop adjoining property, enjoying benefits like higher property or rent values. And next is we have the rehabilitate, operate, and transfer or ROT. It is a contractual agreement where a facility is given to a project proponent for refurbishment, operation, and maintenance, with the government acquiring ownership upon expiry. Last is we have the rehabilitate, own, and operate or ROO. Rehabilitate, own, and operate is a contractual agreement where a facility is handed over to the project proponent for refurbishment and operation with no ownership limitations. So we have the next law, which is the applicable negotiable instruments and documents of the tide. So the laws governing negotiable instruments and title documents in tourism investment include Act of 2031, Presidential Decree Number 115, Warehouse Receipt Law or Act of 2137. Negotiable instruments and documents of title can be useful in tourism financing and investment. Promissory notes, certificates of deposit, mortgage notes, and bills of exchange are all types of promissory notes. A promissory note is a written promise committing the maker to pay the payee a specified sum of money either on demand or at a fixed or determinable future date, with or without interest. So bills of exchange can be draft, trade acceptance, or bankers acceptance. Drafts are drawn by banks and are liable for acts not done in accordance with the purchaser's instructions. Trade acceptance is payable to order and with certain maturity, while bankers acceptance is used for international trade financing. So checks are bill of exchanges drawn on a bank payable on demand. Special types of checks include manager's check, traveler's check, certified check, and cross check. Manager's checks are drawn by the bank's manager upon the bank itself and deemed accepted by the act of issuance. Traveler's checks require the holder's signature to appear twice, while certified checks bear an agreement by the drawee bank that their check will be paid on presentation. Cross checks are done by writing two parallel lines diagonally in the left top portion of the checks, allowing the check to be deposited in the bank, negotiated only once to one with an account with the bank and as serving as a warning to the holder that the check has been issued for a definite purpose. So we also have other commercial documents that are also useful in merchandising, importation, and exportation of goods, including invoice. It is a written account of goods sold, prices charged, or consigned, sent to a purchaser, consignee, and actor, detailing the goods under value. Next is a sales invoice. It is a record of the agreement resulting from negotiations for the sale of goods, detailing the goods sold and the prices charged. Next is we have the purchase order. It is a contract between the party placing the order and the recipient involving agreed undertakings and items. It is used by the purchasing department to order goods, authorize delivery, and submit a bill. Next is we have the bill of lading. It is a written document issued by a courier outlining contractual conditions for the delivery of goods. It identifies the freight, identifies the consignor, and outlines the terms of the carriage contract. It serves as both a receipt and a contract, committing the courier to transport the goods to a specified place and deliver them to a designated consignee. Next is we have the Warehouse Receipt Law or Act of 2137. It encourages negotiable warehouse receipts for storage commodities. Negotiation involves transferring title over the commodity with a debtor bearing loss in case of loss. The true intent is as security. Next is we have the trust receipt. It is a commercial document where a bank releases goods from the entrustee's possession but retains ownership. While the entrustee sells the goods for full payment, the trust receipt law punishes the dishonesty and abuse of confidence in handling money or goods. It aids in financing importers and retail dealers. Next is we have the letter of credit. It is a bank-to-bank transaction instrument that authorizes a buyer or seller to draw drafts on the bank's account under specific conditions. It is a financial device developed by merchants to satisfy the interests of sellers and buyers. The issuing bank authorizes the seller to authorize drafts and pay them upon their presentation. Along with the tender of required documents, the letter of credit trust receipt arrangement involves a bank extending a loan through the letter of credit, with a trust receipt serving as a security. The bank remains a lender and creditor, representing the importer as a real owner of the goods. So next is we have the financing. The rule of banks, the General Banking Law of 2000, Republic Act 8791, acknowledges the crucial role of banks in economic development and their fiduciary nature, promoting a stable, efficient, and globally competitive banking system. Next is we have the Credit Cards Law. It defines access devices as telecommunications services used to obtain money, goods, or services. Credit cards are credit devices used to obtain money, goods, or property, labor, or services on credit. An open-end credit plan is a consumer credit extended to an account, allowing the person to make purchases or loans, pay the balance, or receive a variance charge on unpaid balances. So credit cards are small identification cards that allow holder to credit purchases from various businesses. The Access Devices Regulation Act or RA 8484 protects the rights and liabilities of parties involved in credit cards and access devices. Applications for credit card accounts must disclose annual percentage rate and fees, with detailed explanations provided. However, disclosures may be omitted if the issuer does not impose fees, does not require a fee for telephone solicitation, provides required information within 30 days, and clearly states the consumer is not obligated to accept the card or account. Next laws we have the Special Economic Zone Act of 1995 or Republic Act of 7916. The law establishes the Philippine Economic Zone Authority or PEZA to create, operate, and coordinate special economic zones in the Philippines. The Department of Tourism granted special economic zone status to the tourism development zones and states in 2002, considering tourist-oriented enterprises as primary clients. Next law is we have the business models. Joint venture involves two or more individuals agreeing to share profits, property, or industry similar to a partnership. So a joint venture requires an agreement with a common purpose and equal voice among parties. It may not have a juridical personality and is taxable as a corporation if qualified under the Civil Code. Corporations can enter into consortiums to finance a venture and divide profits. Joint ventures are not recognized under the Civil Code of the Philippines but are granted the same legal status as partnerships. Next law is the franchising. A franchise is a privilege granted to a dealer by a franchisor to sell their products or services in a specific area, often outlined in a franchising agreement, which includes benefits like consultation and financing. So, a franchise is a license from a trademark owner allowing another to sell a product or service under that name or mark. It involves multiple licensing of intellectual property, such as trade names, trademarks, and service marks, governed by rules on technology transfer agreements. The Intellectual Property Code of the Philippines mandates that all technology transfer arrangements must comply with voluntary licensing to prevent abuse of intellectual property rights that may adversely affect competition and trade. The business format is used by 90% of companies involved in franchising, and compliance to the business system is the core element of their contractual relationship. So, franchising agreements have enabled the proliferation of hotels, restaurants, and coffee shops with international brands or names. Next law is we have the taxes. Taxes on income is a taxation of active business income in the Philippines varies depending on the type of income and the taxpayer. Individuals are subject to graduated rates of tax between 5 to 32%, while corporations are taxed at a flat 35% rate. Passive income such as interest, royalties, and dividends is subject to final withholding taxes. Corporations are classified as domestic or foreign, and their taxable income includes income from all sources. Resident foreign corporations are taxed on net Philippine source income, while non-resident foreign corporations are taxed at 32% of gross Philippine source income. Foreign and local businesses in the Philippines can avail of income tax, holidays, and a final tax rate of 5% on gross income in lieu of local and national taxes. International carriers are liable to pay a 2% tax on the gross Philippine billings, which refers to the amount of gross revenue derived from the Philippines in a continuous and uninterrupted flight. So last is we have the Barangay Micro Business Enterprise. So it is the law under the Act of 2002 aims to accelerate the country's economic development by fostering the growth of microbusinesses, integrating the informal sector in the mainstream economy, and providing incentives to generate employment and alleviate poverty. BMBS are businesses engaged in production, processing, or manufacturing with assets under 3 million pesos. So we have the motivational quote. Strong legal frameworks in tourism, investment, and finance create not just opportunities but lasting legacies of growth, trust, and sustainability. So that's all for chapter 12. Thank you for listening.